Hey everyone, and welcome. Today we're going to dive into a concept that, I'm telling you, once you see it, you can't unsee it. We're talking about the missing ingredient in so many trading strategies: time. This quote really gets to the heart of the matter, doesn't it? It's that frustration so many of us feel. You draw these perfect lines, these perfect zones, and then the market just blows right through them. Why? Well, it's because a level without the context of when it's being hit is just, well, it's just a line. I mean, you've been there, right? You spend all this time marking up the chart, the highs, the lows, the order blocks, and then you just sit there and watch price sail right past them. But what if the reason is way simpler than you think? What if your level isn't wrong, but your timing is? Okay, so let's start by breaking down the way most of us are taught to trade, and let's pinpoint exactly where things can go wrong. It's a really subtle flaw, but it makes all the difference. So we all learn to hunt for these things, right? And don't get me wrong, they are absolutely crucial. They show us where the big players, the institutions, have been active. But here's the catch. They only give you one dimension, the price dimension. They tell you where to look, but they tell you absolutely nothing about when. So, what is that missing piece of the puzzle? What's the secret sauce that turns a simple line on your chart into a truly high probability zone?
It's time. It's all about when a level gets tested, not just the fact that it got tested. You have to remember, the market isn't some static thing. It's a living, breathing auction that's happening 24 hours a day, with different people showing up with different goals at different times.
So, to really understand time, we have to start seeing the market for what it is. It has different personalities throughout the day. And those personalities, of course, are what we call the major trading sessions. Now look at this, because this tells the story. The Asia session is usually quiet, right? Low volatility. That's where smart money is building up liquidity. They're basically setting a trap. Then, bam! The London Open hits, volatility spikes, and they spring the trap, sweeping all those stops. And then the New York session comes along to either continue that move or distribute the profits. All right, so now let's see how we can actually use this. How do we build this into a framework that helps us confirm our trades? This is where we combine our levels, the session timing, and market structure to filter out all the noise. But before we go any further, you have got to understand this concept: inducement. This is the engine that drives the market. Institutions literally engineer these fake moves to hunt for liquidity, to hunt for our stop losses. And their favorite tool to do this? Session timing. They know exactly where we've placed our stops, just above the Asia high, just below the Asia low. It's a perfect target. And this slide just illustrates that point perfectly. A break of structure isn't just a break of structure. If you see a BOS, a break of structure, during that sleepy Asia session, you should be suspicious. It's very likely just an inducement, a fake out. But that same exact pattern during the London or New York Open, now we're talking. That has a much, much higher chance of being the real institutionally backed move. So here's a super simple playbook you can use. Step 1, just mark the high and low of the Asia range. That's your liquidity zone. Step 2, wait. You're waiting for the London Open to come and sweep that liquidity. That's the institutions showing their hand. And then step 3, you drop to a lower time frame and wait for that shift in structure, a change of character, or a COH that confirms a new order flow is stepping in. Let's bring this all home, because this isn't just about adding a new rule to your strategy. This is about putting on a completely new pair of glasses, a new lens that lets you see the market with so much more depth and context. This mental model really does change everything. You stop asking if price is going to react at your level. Instead, you start asking, when is it likely to interact with this level, and for what purpose? Is it trying to build liquidity, or is it trying to kick off a real move? So it all boils down to this. The absolute best, A-plus setups, they don't come from just a price level. They come from the confluence of 3 things: the right price, at the right time, with the right structural confirmation. When those 3 things line up, that's your edge. If you take only one thing away from all of this, let it be this simple idea. Your levels tell you where the battlefield is, but it's the clock, the session timing, that tells you when the battle is most likely to actually start. And that's really the question I want to leave you with. Are you just drawing lines on a chart and hoping they work like magic? Or are you starting to understand the auction process, the institutional games being played, and trading with true context? Thanks so much for watching. Seriously, try adding this dimension of time to your charts and just see how it changes your perspective. If this helped you out, hit that subscribe button. We're all about trading with context here, not guesswork.